Estée Lauder commands the most desired luxury beauty portfolio on the planet. Yet, over the last few years, its market valuation suffered a catastrophic collapse. This is a company that owns La Mer, Tom Ford, and Jo Malone. The prestige of their core product lines never wavered. The crisis started in the Asian travel retail market. Estée Lauder relied heavily on duty-free shopping hubs in places like South Korea and Hainan. When Chinese consumer sentiment cooled, massive inventory gluts piled up on the shelves. The external market shift exposed a severe internal flaw. Estée Lauder operated in decentralized regional silos. The management structure was so sprawling that executives lacked clear visibility into their own supply chains, preventing them from catching the inventory buildup until it was too late. Enter new CEO Stéphane de la Faverie. Instead of waiting for the Asian market to recover, he initiated a massive structural turnaround from the inside out, a move that has suddenly prompted Wall Street analysts to issue buy ratings. Investors are realizing that Estée Lauder's crisis is entirely operational. The brand equity is intact. Consumers still want the products. The company simply needs to fix its plumbing, and operational plumbing is highly fixable. For a brief moment in early 2026, there appeared to be an easy way out. Estée Lauder entered negotiations for a $40 billion mega-merger with Spanish beauty conglomerate Puig. The deal ultimately collapsed over a single sticking point, a complex change of control clause tied to British beauty entrepreneur Charlotte Tilbury. Puig had previously acquired a majority stake in Tilbury's namesake brand. If Estée Lauder absorbed Puig, the merger would have triggered a clause forcing them to immediately buy out Tilbury's remaining minority stake, saddling the new entity with an unpredictable, massive financial liability. De la Faverie terminated the negotiations. He chose the much harder path of restructuring the company as a standalone entity. Rejecting a $40 billion acquisition proves that leadership is prioritizing capital discipline. They are actively choosing balance sheet protection over reckless empire building. The first phase of this standalone strategy requires brutal portfolio optimization. Estée Lauder is actively divesting lagging non-core assets. This animated chart illustrates the strategy in action. Capital is being aggressively drained from underperforming sectors. The company willingly took hundreds of millions of dollars in trademark impairment charges to write down struggling brands like Too Faced and Tom Ford. Those resources are then redirected into proven double-digit growth engines. Look at the lines outside Le Labo boutiques. Estée Lauder is doubling down on high-margin luxury fragrance. This is the financial logic of shrinking to grow. By absorbing the short-term pain of impairment charges, the company clears out toxic overhangs, leaving a leaner, cash-generating core. This graphic shows the shift in corporate structure. The sprawling, disconnected regional hubs are collapsing into a single, centralized operating system, one ELC. By cutting up to 7,000 roles, this consolidation generates nearly $1 billion in annual savings. We are already seeing the operational impact. Estée Lauder appointed WPP as its single global media partner, eliminating the redundant marketing spend of dozens of fragmented regional agencies. The mechanics of the turnaround are straightforward. Management is systematically extracting capital from bureaucratic bloat and injecting it directly into consumer-facing advertising and AI-driven analytics. The recent fiscal data proves the strategy is taking hold, even as broader market headwinds persist. This split-axis chart highlights a compelling financial paradox. Overall net sales actually decreased by 8%. Yet, driven by extreme operational efficiency, Estée Lauder's gross margin expanded by 230 basis points. To prevent another supply chain trap, they are rebalancing geographic risk. They stabilized the U.S. market by expanding distribution into Amazon Premium Beauty, deliberately reducing their reliance on Asian duty-free hubs. Estée Lauder's trajectory demonstrates how corporate turnarounds actually succeed. True valuation repair does not come from masking underlying problems with $40 billion acquisitions. It comes through ruthless simplification, centralized discipline, and protecting the core brand equity. This video is for informational and academic purposes only and does not constitute investment advice. If you found this insightful, please follow Wall Street Review, like, and share.